One of these days, the economy will slow down. And I believe we will have a recession. I don't believe the Fed is going to hold it off forever. We'll have a slowdown, and it's natural. And when we do, the markets will go down, defaults will go up, bankruptcies will go up, people will panic. Some things are inevitable, but you really shouldn't think you know when.
Hey, what is up, guys? We have been through the biggest expansion in the financial market history. More than 10 years ago since we have seen major market correction. In this video, I will explain the market cycles and why recession is inevitable.
Short-run economic forecasting is a black art. Nobody does it very well. For what it's worth, people who are tracking are feeling moderately depressed right now. They're seeing slow growth right now, and the bond market is acting as if there's a pretty good chance of a recession sometime in the next year or so, but who knows? There are all kinds of things that could be going wrong. China is clearly struggling. Europe may very well actually already be in recession. We probably are suffering the deflation of a tech bubble. Corporate debt has gotten it. I've been saying there's no one thing. This is if we're going to have a recession, it's going to be a smorgasbord recession. It's going to be no one thing, but just a bunch of different things.
Why all the doom and gloom? Mainly, it's because the bond market recently flashed warning signs that a recession could be on the horizon. Other economic indicators, like U.S. manufacturing activity, were also lower than analysts expected. So when could a recession hit? And how will we know?
It's been now quite some time since the 2008 recession. So the US economy now has been growing for 10, 11 years. It's a very long expansion. We've seen recently, if you just look at the popular press, a bubble, I would say, in discussion about recessions. Everyone wants to talk about it. Is there one just around the corner? The fact that the expansion has lasted so long has no predictive power whatsoever for whether a recession will start tomorrow.
If I had to pick a date for the next recession, it would be sometime in 2020. We're in a self-reinforcing virtuous cycle. Lots of jobs, low unemployment, wage growth is accelerating. That's supporting more consumer spending, which is causing businesses to hire, which is pushing unemployment down. So we're in a very virtuous cycle. That's pretty hard to break, but it can get broken. And in my view, that probably would occur in 2020. So the policies, the economic policies that the administration is pursuing is doing damage to the economy, and that's going to become increasingly more obvious as we move through 2019 and 2020. And that's why I think 2020 is the day of reckoning. If there is a day of reckoning, that's when the economic expansion will end and a recession will ensue.
Before we jump into the next recession, let's talk about market cycles. First and foremost, everything goes in cycles. Trees do not grow to sky, and not everything goes to zero. This is true in our economy, this is true in financial market, and this is true in human nature. There is such a thing as life cycle. People receive birth, they live their lives, and they die, and process continues. When dealing with humans, let's remember we are not dealing with the creature of logic and rationality. We are dealing with creatures of emotions. As long as humans will make financial decisions in the market, then we will always have cycles. Maybe sometimes in the future, the entire decision making will be animated by AI, then cycles might be disrupted. But I highly doubt this will ever happen, because people tend to believe they are smarter than everyone else, and they also like to gamble. Let's go 20 years ago and see how cycles occurred in financial market. In 2000s, we had a dot-com bubble, which was fueled by internet IPOs. Investors were literally throwing money at any company that has something to do with internet. It went from hope to optimism to belief to euphoria. At 1995, S&P 500 was trading at around $500 a share. 5 years later, it was trading at $1,500 a share. That is a 1,000 points increase within 5 years. If we convert it into percentage, that is 200% increase or 25% annual compound rate of returns, which is pretty huge for a stock market. Euphoria does not last forever. After euphoria, we go to anxiety, then denial, and finally panic. And this is exactly what happened. Market crashed from $1,500, dropped by 50% within 2 years. When market was in panic, Fed was able to save the day by cutting interest rates. It dropped from 6% to 1% and stimulate another economic cycle. From 2002 until 2007, S&P 500 doubled again within the same time frame. This was another market cycle, but increased for a different reason. This time, it was not fueled by internet IPOs, but rather housing bubble that caused global financial crisis. Banks were lending subprime mortgages to people who could not afford the house and did not even have a decent job. After that, they packaged all the subprime shit into a bond with AAA ratings from credit rating agencies and sold that garbage throughout the world. Basically, transferring toxic gas in the box from United States to different parts of the world. But since people aren't creatures of logic, but creatures of emotion, they continue to buy those houses and fueling bigger and bigger bubble. Because no one wants to miss out those cheap money. Euphoria did not last that long. Market halved again, dropped from $1,500, people lost their houses, and major banks went underwater. But wait, they didn't go down. They got bailed out by government. The Fed once again dropped interest rates from 5% to 0% and started another economic expansion. Now we are currently at the longest economic cycle that lasted for more than 10 years. Since the housing bubble when S&P 500 was under $800 a share, now we're at almost a new all-time high at $3,000 a share. That is 2,200 points increase within 11 years, or 270%. It seems like we could be in euphoric state, because the economy is doing so well. But there is a problem. Current interest rate is at 1.85%. If something happens to the economy, it could be a game over. I believe Fed will not decrease interest rates anymore. I believe they will raise interest rates up to 4% at least, because they have to. In Europe, interest rates are negative, basically what it means that banks will pay you interest to lend you money. What a beautiful deal. And people will do stupid things when you lend them cheap money. Let's take a look what one of my favorite investors, Howard Marks, has to say about market cycles and our current economy.
When do we get to the point where a recession is something that has to be avoided at all costs?
Yeah, well, it's a big mistake. In one of my memos, post-mortem, for the global financial crisis, I talked about forest fires.
Yeah.
And good forest management, you permit there to be fires once in a while. And if there are fires of moderate size, occasionally it burns out the fuel, and then you don't get the one big one. Right. Same thing, in my opinion. And the fluctuations of the economy are natural, in my opinion, and should be permitted to occur.
Yeah.
And if you try to forestall them, then when they happen, I don't think you can forestall them forever. And when they happen, they're bigger.
So do you mean when you look across the landscape?
And the attempt to forestall them creates moral hazard.
Yeah.
That's the key.
But when you look across the landscape at this kind of construct that we've built ourselves within the Federal Reserve or the central bank controlled world, they can't control this forever, surely.
Right.
There must come a point where things get out of hand. Do you sense, going back to that original question about 2005, 2006, do you see any similarities in what you're seeing, what's starting to make your spidey sense tingle?
Not similarities in the sense of specific things repeating.
Yeah.
But I have felt that because people were traumatized by the Great Recession, the recovery has been the slowest one since World War II, and that has kept things moderate, which meant that we would certainly have a recession one of these days, but it would be moderate. It wouldn't. When you don't have a boom, you don't have to have a bust, in my belief. But now, between the tax bill, which was a shot of adrenaline into, in my opinion, an already healthy patient, and then the possibility that we're going to see a Powell put in action, I think that we may get to highs that lead to lows. I think that when I was writing, I'm a believer in cycles. I believe they always have occurred. I think I understand why, and I think they always will occur, and I try to study them. And then when I kind of got to the end of writing the book, I said, well, why do we have cycles? If the market goes up 10% a year on average, why doesn't it just go 10% every year? Why? And in fact, it almost never goes up between 8 and 12. So the average is not the norm. Why not? And the answer, I think, is excesses and corrections. So you have a trend line, and most trend lines are upward sloping.
Yep.
But then you deviate from the trend line on the upside because of some combination of optimism and greed and wishful thinking, and then you have to have a correction to the downside. So now I'm thinking we may have more of an excess, which leads to more of a correction.
I've thought a lot about this too. I'm a great believer in cycles, and everything I've read in history demonstrates beyond any argument that they do exist everywhere. And when I think that through, I put that down to a human level. There's a cycle of life, and markets are nothing but the collective representation of our greed and our insecurities and our cycles. And
that's a major theme of the book.
Yeah, exactly.
And
but it's a hard thing to argue that when people, and I've had a lot of people tell me I'm wrong. Cycles don't exist, and you shouldn't really build any kind of investment thesis around them, which I find remarkable.
The cycles come primarily from the behavior of people.
Yeah.
And I don't see how you can argue that people are not prone to excesses.
And repeating.
And repeating them. And the big theme of the book is Mark Twain. History does not repeat, but it does rhyme. And the world is just too unstable a place to believe that stability is the norm. And, if you think about it, in the economy, a great year is up 4, and a bad year is down 2.
Yeah.
So the economy has an upward trend, and it kind of goes like this. Then companies have leverage, financial leverage and operating leverage, so their profits go like this, and then the market goes like this. And why? Because of people. Yeah. The risk in the market does not come from stock certificates, companies, exchanges. It comes from people. Yeah. But people are prone to excess, and I don't see how it can be argued otherwise. And by the way, when people say, I don't think we're going to have cycles in the future because the astute Fed has it under control or whatever it is, what they're saying is what I consider the 4 worst words in the world. It's different this time. Okay, until now we've had cycles, but we're not going to have any more.
So let's talk about the economic reality of this, because the political reality is, you and I are never going to get to the bottom of this in the time we have. But the economic reality, how do you take what you've observed on the political scene, you take what you've looked in terms of asset prices and valuations, and you take what you've seen from the Fed and the interest rate cycle, how do you apply that to your investment philosophy right now? Has it changed anything? Has it made you adjust anything?
I think that, Grant, the most important decision for an investor at a point in time with regard to the intermediate term, by which I mean not tomorrow and not 30 years, but the next 2 to 5 years, the most important decision to make today is whether to invest aggressively or defensively. And it's not all one or all the other, but how do you mix the two? An investor like me faces 2 risks every day. The obvious risk that everybody knows about is the risk of losing money. The other risk, which is a little more subtle, is the risk of missing opportunity. And so what most people say is, well, I don't want to lose a lot of money, but on the other hand, I don't want to miss all the opportunities, so I'm going to do something that compromises on the 2. And each person's positioning vis-a-vis the 2 risks should be different based on their circumstances. But still, then that's the first question. And then the second question is, you figure out your normal risk position, and you look at today, and you say, well, today, should I be worrying more than usual about losing money or more than usual about missing opportunity? And, I just think that the world is an uncertain place, and the things we're talking about contribute to the uncertainty. And so today I would emphasize avoiding the loss of money a little higher than usual vis-a-vis avoiding the risk of missing opportunity.
Everywhere you look across the financial landscape, there's a series of successful and importantly pragmatic investors who are coming out and issuing what the headline writers call stark warnings or dire warnings. Seth Klarman being the most recent, perhaps, during the Davos thing recently. That I'm always interested that cacophony of voices that gets louder and louder and more respected by the day doesn't seem to change behavior at all. We seem to be in this period where, to your point, that fear of missing out is being re-weight adjusted by the smart investors, the guys who are always early, and yet the retail investors are wiping their brows and saying, well, December's over, Kramer said the market's going to go up, we should investigate the dip on Christmas Eve, everything's good again. Do you, when you look at the way average retail investors think about this, do you really want to find a way to reach out to them and say, listen, you need to think about it like this, you're not thinking about this correctly?
It's a tough one,
yeah,
Grant, because I always imagine, the movies that are made for the teenagers. And over here, sitting on their shoulder, you have the angel saying, don't do it, it's not prudent, you'll regret it in the morning. And over here you have the devil saying, do it, it'll be fun. And the devil wins.
Every time.
And then that's why we have the movies.
Right.
But in the investment business, you have prudence and history and knowledge of cycles and consciousness of the risks. And over here, the devil says, do it, you'll get rich. And wishful thinking, the desire to get rich is really dominant, and the fear of missing out together. And so we saw in the fourth quarter an incredible swing of psychology from positive to negative, but then back. And most of the damage has been made up. Most people don't invest in the long term. They're just trying to bet on what the market's going to do. The retail that you describe, but also many professionals,
yes,
because they're afraid to be cautious and miss a good month,
yep,
because they could lose business. It kind of goes back maybe to your first question, which is that most people are afraid to be wrong. And since the market goes up most of the time, being wrong consists of being out, which means most people are afraid to be out. And so their nature doesn't permit them to get out until
it's too late.
Until the crisis is upon us.